Welcome back, everyone, to another episode of the EUVC podcast, what I hope has gotten to be your gateway to the pulse of European venture capital. Today, we're joined by Dr. Elisabeth Schrey, Managing Director of the Deep Tech and Climate Funds, also shortened as DTCF, which is a €1 billion investment vehicle co-funded by Germany's Future Fund and ERP's Special Fund. DTCF is designed to bridge the growth stage funding gap for European deep tech and climate tech startups. In this episode, we'll delve into the critiques of DTCF, the role of government capital in growth stage investing, and of course also strategies for navigating the evolving climate tech landscape, which I know there's a lot of you out there that are thinking about these days. Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC's innovation banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, SkyTech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to SkyTech this year. If you're gearing up for your next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, or connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Let's get to the very first section of today's conversation, Elisabeth, the role of government in growth stage venture capital. First of all, tell me, there is a critique that many people put to anything that's public, which is, should we really have it? Tell me, Elisabeth, what puts you in the position to be able to deploy this money wisely? What makes DTCF be a meaningful player in the ecosystem?
Yeah, thanks, Andreas. When I took over the role of the managing director for DTCF 2.5 years ago, I was motivated very much by the fund size in general, because there are just very, very few funds with this volume. And secondly, to focus on the early growth stage, because I come from a seed investor perspective, and I always saw that it's quite difficult to put together rounds that are above 20 million, 50 million. And many of the startups in Germany, but in Europe in general, really, they should get the more funding and stay more focused on the development instead of trying to fundraise continuously. So I was looking forward to going into that financing gap. And now 2.5 years later, we have signed 17 investments and we continue to have a super strong deal flow. So I believe that the fund is in the right stage. And some of our portfolio companies already have some follow-on financing secured, which shows us that the selection process is right. But we will dive deeper, I think, into our criteria and also maybe the disadvantages that might come with public funding. So looking forward to dive deeper.
Let me ask you the first question that some people critique you for, which is that DTCF, of course, is a co-investment fund, which means that you require at least 30% of the capital coming from external sources. How do you address concerns that this structure limits DTCF's ability to lead rounds and meet founder expectations for swift funding?
Yeah, that's true. So we cannot offer term sheets on our own. We can co-lead rounds, though, and facilitate term sheets. And this is an advantage if we partner up with corporate venture capital funds or with family offices, because sometimes those players, like to work together with us because they don't have like a large investment team, speaking of family offices. And we do a lot of work on managing the investment process, and then we come together to agree on terms. And there we actually facilitate rounds. And on the other hand, with corporate venture capital funds, we can be a neutral buffer between the strategic interests that sometimes come along with those funds and a more independent development on the other side for the startup. But the negative aspect that we cannot lead rounds, it's there. But we also take the fund size quite, we try to be very responsible with the fund size. So we don't want to decide super quickly, and quick decisions for our ticket size of 5 to 10 million initially in our sweet spot. I think it would be a bit irresponsible to be super quick and not do any due diligence and just put in the money without any other co-investors. So having a syndicate of other investors, also normal VC funds, is reducing risk as well, and spreading work, and also from a founder perspective can be quite beneficial when you have several perspectives later in, for example, in the board.
Very common argument against public actors or government-backed funds like the DTCF is that you might crowd out private investors. I actually come from a background of helping deploy capital on behalf of the Danish state, and that was definitely one thing that was heavily critiqued always. So this creation of market distortions. I'd love to ask you first and foremost, maybe steelman both sides of that argument, that yes, in these cases it is right, and on the other hand, you can definitely also view it from this perspective. And then after that, we can maybe go into what you do to help ensure that you complement rather than compete private capital.
Mm-hmm. Yeah, that's super important. And I mean, there is a contradiction itself if we want to have private capital in the round, but we don't want to crowd out public investors. There is a small part where it makes a lot of sense. And for us, it is a walk on a tightrope, if you can say that, because we want to be part of the promising deals, of course. And in those investment rounds where we see like large generalist funds placing their bets in the deep tech space, we want to be just a party who increases the total round size, and we will just deliver one piece of the whole puzzle that's needed for investment heavy topics. But for example, we don't focus on like SaaS companies where we have a lot of growth capital in the market already. If we have a deal in our deal flow that is looking good and also is in the SaaS space with good KPIs, we could do the round. But there, I think there is a lot of competition on the fund size, and that we don't really step into. Our sweet spot is where the deals include a lot of hardware in the business model, or have long development cycles or commercialization cycles. And there you have this big investment need, and there usually the large funds don't step in when there's still some tech risk in the company.
Let me ask you, Elisabeth, let's say you have a round happening and you're interested in the investment, in putting an investment on behalf of DTCF, and it turns out that there is competition for that 10 million piece that you were planning. Do you back away, or do you compete for that if there's a rival term sheet?
So I have to think about the last processes that we were in, and I remember one case from last year. There were several term sheets on the table, and we were part of one syndicate, and there was another syndicate without us, and we didn't play a super active role in getting this deal done. There were still some concerns from our side, but also from the other investor side, and we didn't do the deal in the end. So that we didn't distort the market. It was also more on the seed side. So in the end, two seed investors did the investment, and that was pretty fine for us. In other rounds, we are, for example, invited, but not with our preferred ticket size. So we prefer to put 5 to 10 million initially to not get a too large portfolio, because if you would place bets with 1 million, then it just gets too big. But sometimes, for example, in Proxima, the nuclear fusion company where we invested last year, and there was a follow-on round this year, we put just a very small ticket initially because there was a lot of demand from the other investors. And then in the follow-on round, we extended our shareholding because there, we could deploy more. We were asked to do more. And we were actually quite happy to put a large piece in there because we really believe in the company.
How do you balance it as the managing director and together with the board or whatever is the top governing body that you have when you make these decisions? Do you, when you're a VC, it's clean cut. Will this allow us to return more capital to our investors? In this type of situation, what is the guiding principle, the guiding factor that allows you to make that call when you don't know whether you should step aside or you should compete for an investment?
We ask ourselves if we are needed as a fund. So we do want to bring back nice returns to the government, but also we have a carry program, so we are incentivized on our own to do economic investing. And we ask ourselves if we are needed in that round because the capital requirement is very large in the long run, or if it's something that other investors could do as well and are fighting for to do as well. Since we steer our deal flow from the beginning to focus on topics where it might be a little tricky to either have enough funding in the long run or find funding in the stage where the company is at, for example, before industrialization on the production side, where you just have very small revenue and don't know whether it's working out in a full scale production, that it's quite difficult for the companies to put together a round, which is purely existing, which is purely counting on equity. And we try to create an impact in facilitating those rounds, which are a bit tricky. If we would steer our deal flow and our team to look into the traditional enterprise SaaS companies and hunt for the best SaaS KPI Series A startups, then it would be quite tricky. It would be also more tricky to win the deals, I think. So I think there is a natural balance of where we are needed, the deal flow that comes to us, and those where we say we're not quite needed at the moment. Maybe another part of the answer is we believe that we can create an impact. We believe those companies have the potential to grow a lot on the valuation side as well, but it might take longer. So this is where we say it's okay to still take a bet, like a tech bet in the early stage, but deploy more capital.
Yeah. So in other words, as you described it in the beginning, and this, of course, conversation explains it so clearly or shows so clearly how you're walking a tightrope, because in the end, you have a mandate that says you're only there to support the ecosystem, or that's your primary role. But on the other hand, you also have a carry kicker to incentivize you as the management team so that you actually make good decisions and you can attract the best talent. And this is obviously two dueling powers. And I think that there's not much reason to continue diving into it, because in the end, it has to be a process of iterative feedback also from the ecosystem. At least that's what we could see in Denmark when I was part of the program here, which was, well, you had an actor that was not being maybe playing as much the role of solving on behalf of the ecosystem, which then meant that you ended up having pressure from the angel investors saying, this program is no longer a good solution for us. It is actually more someone who we're competing with. And thus it becomes more about that iterative feedback loop from the private actors that then come back to government and saying, it's not functioning. Right now, it's become too much of a competitive private type player.
It is what you described. We try to, I think in the early growth stage where we are looking at in round sizes above 10 million up to, let's say, 70, 80 million is where we feel very comfortable. There is a big demand for investors which is not met yet. So we get quite positive feedback and yeah, we have a very nice deal flow. Maybe this will change in 5 years if a lot of multi-hundred million funds come into the private sector. Then maybe we're not needed for, let's say, a second fund time, or we will just purely act on economic terms in a second fund generation.
Let me hear what you said there. What did you say in the end with the second fund generation? Would you do you expect that you will evolve to become a purely financial player?
Well, this is too early to tell. It's just that our investment period for initial investments goes 5.5 more years. So in the end, if the investment period is done and we just focus on follow-on financing rounds, then we think about what will come next. And it will be maybe not enough to just focus on portfolio management, but to continue initial investments. And if we think about a second fund generation, we think, how should it be structured and what is the dynamic of the market at that time? Is there enough growth capital for that field, or is it still there's still a demand from a government-backed vehicle? So this is what I'm just speaking into the crystal ball.
Very exciting. Tell me, there's also the European Commission's recent initiative to launch the Scale Up Europe Fund. It's, of course, also meant to address the late-stage funding gap. I'd love to ask you, how does the DTCF position itself up against this broader European effort?
Yeah. So first of all, we are super welcoming to every larger growth fund. Maybe the difference is that a fund from the European level is not limited by the EU state aid and competition law, but it can just act all across Europe. And we focus on the German companies or those that have any kind of business activities in Germany. So this is one difference, but they are just very, very, very few funds that could place tickets of, let's say, 50 million and above, not in Germany and not on EU level, especially in those kind of companies where it's still in the development stage, deep tech companies. So this is, I think it's needed and it's good to have that.
Now I want to ask you a completely different route of questioning here. This is about mapping a framework for growth stage investing in verticals under pressure. We obviously know all that climate and green tech is not a space that is completely unimpacted by what's happening in the States. And I don't want to ask you as much about just what's happening in the green tech and the clean tech and climate tech space, because those conversations we've had many times. But I would love to try and deduce from your learnings from investing at the growth stage in a sector like climate, where policy and tech pathways are so rapidly evolving, what are the foundational principles that guide your investment thesis?
That is a tough one. So about the shifting, I think there are always waves in venture capital, right? You have several clean tech waves, you had enterprise SaaS, and now we have a strong deep tech defense deal flow. But the 4 verticals that are on our website, like climate, industry, computing, but also life science, industrial life science, they don't shift, they are consistent. Also, the climate vertical is consistent. And what is changing are the subcategories below that. So I think in an earlier version of our website, we still had crypto on as one of the sectors, but we didn't do an investment yet. We're open, but of course, it faded away a little bit. So this is not as prominent. And there are some strategic tech sectors, especially from a German angle, that we know we need some solutions. Energy transition, for example, is one of those. Or Germany is very strong in production tech and engineering, automation. This is something where we believe the whole economy needs to be transformed, and we want to enable independent, large, new tech companies. So this is where one of those decacorns might grow. And there we want to place a few investments. And then there are some European sovereignty topics. I think new space is one of that, for example, or semiconductor, because we don't have the autonomy in those areas. And there we also believe large companies can grow, and this is a demand that will not go away in the future. I think on this very low level, it's shifting, but there are some topics that just remain there. And we don't jump on every, I don't know if you can say that in English, but if there's a new topic, we don't want to be the first investor in the first deal that comes there, but we monitor a little bit what companies are out there, what is the market dynamics, if it's the right time for us now, or we should wait a little bit. And one of those areas is, for example, sustainable aviation fuel, where we looked at a few deals, but in the end, we didn't decide positively for one. So maybe it was a bad decision from us. We didn't find the right deal as well from a structure perspective. But maybe it's also good because the sector still takes a while to show like significant commercial traction.
I'd love to ask you, because part of course, your capital is there to help scale companies. I'd love to I'd love to be helped understand how you define that readiness for scale when it is companies that are in these uncertain verticals, where on the one hand, you have business model moving constantly, but you also have the regulation, which is still forming. And then add into it, as an example, the geopolitical movements changing as well. So how do you go in, and what are the exact way that you try and understand this?
We are a little bit flexible with this requirement, readiness to scale, because when we look at the different sectors, some markets are there already, and some markets will just evolve in the next 5 to 10 years. For example, if you have any new way to generate electricity, the market is there, obviously. But for example, for quantum computing, it's not there yet. But with the technical development, the market will arise. And I think it's quite simple. We don't wait for readiness to scale in every technology sector that we look at. In some, we just take the tech risk, place our investment in a still early TRL level, but we believe those are the deep tech companies that can be category leaders and create a lot of impact and can become decacorns. And in other areas, we actually want to see the readiness of scale in terms of the product is ready, the market is ready. Show us how you want to scale the production, like what kind of machinery do you need, what do you expect as yield and utilization, and what does it do to the material cost, like this granular level of plans. But it is a very differentiated approach. So in each tech sector, our expectation is different.
Can I ask you to double click a bit on this topic of policy fragile businesses or policy fragile verticals? How do you think about those?
If a business model is only working because of some subsidies, then it's not very resilient, or then we don't want to do this. One example is is in the recycling world, where for a certain period of time you might have recycling fees so that you don't pay for the input, but you actually get even money. You have negative material costs. But in those business models, we look at the unit economics, if it's also viable without the negative material costs, but what is the sensitivity there. And I think, this takes away a little bit of the exposure to policy making. But some developments, I think you cannot really foresee. So we might also be surprised. So we just try to to not be too much dependent. And there were a lot of articles about the green premium and how it has been buried this year, basically, because no one wants to calculate with that. And I think it's the right development to look into real economically viable business model without too much fantasy, too much support.
I'd love to ask you specifically now, because I've tried to keep it on the principle level. But if we go to climate and we look at what has happened there, and we look at how people have been adjusting, we just put out a podcast the other day with Hampus Jacobson from Pale Blue Dot, which is one side of it, where he's coming down on the side where he's saying, let's just not be dumb and actually invest in the things that will save our planet. And we right now are producing in so many ways that are not sustainable and not smart in any way. So let's all just not be dumb. And then there are others that have models that seem seemingly more tied to the regulatory environment and the opportunities that arise from that. Where do you fall on that? How do you think about that? And where do you what have you learned over these last, let's say, 12 months?
Yeah, so I personally, I had a pet topic that I like to look at, which was clean water and then technology around water, and especially on the open oceans, because you have a lot of this, plastic and so on, but also pollution from vessels and so on. And there are regulations in place that you should not do that, and you have to take specific measures to not do that. But I found out that there's not like one authority to take care of that. So even the regulation is in place and there are high fines, but who is following up on that? And I think this is a question you always have to ask yourself if you have this aspect in your business model of regulatory tailwinds. If it's really how much you can be sure that is there also in a few years from now. One aspect where I think policy plays a major role is in the hydrogen business, because it has been praised like this is coming and helping us decouple all the sectors. And we within our team, we had 5 people looking into the different green molecule deal flow companies to find out which is the right application. And we follow those thought leaders like Michael Liebrecht, I think, and try to understand where it's coming. Maybe, and in those cases, there's also an opportunity if the market, if it doesn't get a lot of attention at the moment, but we really believe that it's coming for a few applications, then place the bets now when the valuations are at a very realistic moment, and not when it gets maximum attention, but the valuations are maybe too high. So for example, in hydrogen, if we find a technology that could be used for fuel cells and electrolyzers on a component level, so it's less on the application side, but more on the enabling side, that is something that could make the cut at the moment.
I'd love to ask you a bit about how you think about this when tech is waiting for the market versus when you're actually just double down. And you did mention it earlier as well, that you're not always waiting for that ready to scale juncture to be met. I'd love to ask, where do you land on that? How do you think through that?
Yeah, we still see that in Series A companies sometimes, or we think it might be a case of tech waiting for customers. I think this trap is bigger in the earlier stages. Yeah, we try to understand the market as much as possible. So if there is an adoption already, and how much the customer return on investment is can be calculated already. So if it's very, very far away from a positive ROI and the demand is also not showing, then we take a step back and say, let's wait until this sector or this area of startups gets a little bit more traction. And sometimes the number of startups decreases naturally in this sector. But maybe sometimes we also see it coming back in 2 years, and then it's in the right time. But it's an observation for each market, and it's super difficult. We do ref calls, we align with other investors, we ask our corporate contacts, so learn from conferences as well. There are so many sources we try to take in to understand if it's the right time.
Can you tell me a bit about what your plans are for expanding the DTCF portfolio and the impact across Europe?
So we are looking for people to join our team. Small advertisement here. Because we want to continue with this pace of signing, let's say, 8 startups per year. So happy to talk to anyone who's interested. There are a few sectors where we haven't made any investment yet, but where we believe we could do several investments. For example, in the automation space, robotics in any kind, semiconductor on several levels. We are excited to look at companies there. In cybersecurity, for example, yeah, those are like subsectors that we think are very important and fit very well with our thesis. And across Europe is the other aspect of your question. We can invest outside of Germany if any business activities are happening in Germany. Like you are a team, you have production side, you have a sales office, stuff like that, subsidiary. And we are about to sign our second French investment. Yeah, within the next days. We have one investment in Switzerland, but the main team is in Munich. So we are looking to expand. And if there's any tech hub or that you would recommend, I'm also very open to travel and have a look. And our team is always on the road, not always, but often on the road to be connected to a lot of players.
How big is the DTCF team?
We are 13 people. And we want to be maybe 20 people when we are at full growth.
And you're all based in Germany, of course.
Yes.
Which cities?
I'm based in Munich with a small team. We have a team in Berlin and a team in Cologne, Bonn. So it's in Berlin and in the west.
Let me ask you the question that anyone in Munich normally loves, but which, since you represent all of Germany, will be a harder one. Germany versus Munich. Why is it that Munich has picked up so much in venture lately, and what's happening in Berlin?
Well, I think Munich, with all the large industrial players around, is well positioned for hardware tech companies, and the ecosystem that has been created with the help of Klatten around TUM, the TU Munich, Technical University Munich, is also, it has been active for a few years now and produced a first batch of very successful companies. So this ecosystem is just one step more mature in comparison to other technical universities. And in comparison to Berlin, Berlin is amazing as well. I think we have a few portfolio companies there already, also with hardware. So it's not only focusing on software, but it's difficult to differentiate. I think mobility, aviation, stuff like that is usually more linked to Munich because of the industry around it.
We have a content strand on EUVC, which is focused on corporates. I'd love to, and you've mentioned corporates a couple of times, so I'd love to ask you a bit about the role of corporates in the venture ecosystem, how you collaborate with them, how you see them differently from the normal venture ecosystem.
I mean, there are a lot of classic disadvantages that are usually repeated, and I think they're all valid, but there are also a lot of positive sides. And in the stage where we are looking at the companies where you need some large scale offtake agreements, maybe joint ventures to secure feedstock for the processes, or with help on the distribution side, it makes sense to cooperate. And we have a few co-investments with corporate venture capital funds. Some of them turn out well, some of them turn out okay. Also, 2 of them have a delay on the commercial side now because you are dependent on one customer, on your the major go-to-market is with one customer. But in general, I would say it's rather positive. So it can be really an acceleration in the go-to-market. So, for example, with Rewe, the supermarket chain, and our company, Project Eden, they do a meat alternative based on a textile industry production tech. That helped a lot. They first started in 1,000 supermarkets earlier this summer. Now they go into more than 2,000 supermarkets. And this is super helpful. The team is super great.
Yeah, very cool. You have some good supermarkets in Germany doing good things for the venture ecosystem. Let's go to our section that will close off today's conversation, which is insights and advice for founders and investors. I'd love to ask you first on the founders side that seek to partner with DTCF. What key qualities or milestones do you look for when you assess them?
We usually have really great tech teams and a well-rounded C-level. And two qualities that we don't see in every team that we look at is, for example, hiring experienced and sector-focused people who are maybe 10 or 20 years older than the founders, but have really sectoral knowledge is something that stands out and shows a lot of different qualities in the founder team. So this is something we like to see. Or on the other side, on the financial part, we like to have good financial modeling as well. It sounds like a no-brainer, but it actually isn't. Especially with cash flows, for example, you have a lot of capex, and then the cash flow management, working capital. It's more important for the deal flow that we look at because we have this physical goods in many cases, and there we see some differences. So this is cool if this is settled.
And if we then turn to the investors, what can the private investors, be that VC funds or family offices, how can they think about partnering with you?
Well, we are open for every kind of partnership. If it's a great syndicate, we can just be a follower. And usually with our ticket size, we play a major role in the round. So we like to be in the closer circle of information and strategic decisions. But we don't have a big ego on having a voting board seat or something like that. What they can expect from us is, in some cases, we could deliver really nice links to policymakers in Berlin because of our role. So this is where we played the state-owned VC fund in a positive way. We also have a quite tech-savvy team. So sometimes we can, if we partner with generalist funds, we can be the deep tech perspective on a board and have a lot of understanding maybe for complex development projects. So this is something that we also like to bring to the table. I think we try to be friendly with everyone. For, as I said earlier, with family offices, we can offer like taking over the process management and let's say providing due diligence reports and stuff like that.
Yeah, which is a powerful role. You can always say, well, that puts more power, so to say, or more influence on the flows of capital to that type of organization, which some people would think is both a good and a bad thing. But it's definitely something that I can see that there's a lot of demand for, I imagine, especially on the tech side. Let me ask you one final thing, and that is reflecting on your experience. What advice would you give?
Now I'm curious what's coming. Sounds like a good question.
I wanted to hear, reflecting on your experience, what advice would you give to emerging VCs and policymakers that strive to build a really robust and inclusive European tech investment landscape?
Well, I'm impressed usually when I talk to new fund managers, when they have a very clear strategy and the strategy is rooted in previous experience. So I think it's pretty cool if you have a very clear niche that you're focusing on. For us, we don't need a sectoral niche because we have this large fund. But if it's smaller, it makes sense to really pick one aspect. And one aspect that was that came up in the last month or maybe 1 or 2 years and got a lot of attention from me because I really believe there is a gap is the late VC, early infra, and PE side. So how these three players merge. And I think in this area, which is a gap at the moment, we will see new players and policymakers start to offer projects that finance this aspect. For example, the FOAC, first of a kind financing activity. But I also see private funds targeting this gap. If I would raise a private fund right now, I would target that because I believe there you can find good deals, offer maybe more than equity to the startups, and create quite an impact.
Elisabeth, thank you so much for joining to take some hard questions, I think, a bit about DTCF, but also some of the ones that, are just needed to make sure that everyone understands exactly what role you play and how you do it.
Thanks, Andreas. I really enjoyed the conversation, and thanks for thinking about so many good questions that really show what we do and what's critical at the moment, I think.
I'm very happy it was a good experience. Thank you so much for joining us.
Thank you. Bye-bye.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC Innovation Banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, SkyTech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to SkyTech this year. If you're gearing up for your next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.